It's 11 o'clock. We'll stand to say the pledge. I pledge
allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you all. All righty. First on the agenda is the agenda approval.
Mr. Chair, we, having the county board having just approved the sale of that housing parcel at a reduced rate, we would add an item under old business after 6A and before 6B
Okay.
for consideration of purchase of that parcel and development options for that parcel.
All righty. Thank you. And with that, if I can get a motion to approve.
I'll make the motion.
Thank you, Steve.
Second.
Thank you, David. All those in favor, say aye.
Aye.
Opposed? All righty. Public input. Since I see no public for input, we will pass on that and go on to the consent agenda.
I'll move to approve.
All right, thank you, David.
I'll second. Oops.
Who seconded it? Tom, okay. Those hearing voices. Any further discussion? All those in favor say aye.
Aye.
Opposed? Motion carried. Old business. Acquisition of TFL parcels for commercial industrial development. Mary, I think that's you. Or is it Jeff?
Yes. So we have been having the discussions about the industrial parcels that are available and the desire to purchase them for future industrial development. This would then go ahead and secure those parcels so that we can start creating a marketing plan and then actually start looking at road design and some of the pieces that go with that, and identifying potential resources then that we can use to facilitate the payment of the cost of the infrastructure that's necessary.
And I would add that when we apply, and we look at the budget for Fund 91, which is combined HRA and EDA, we had a balance for 2025 of $464,000 plus $100,000 that was budgeted for acquisition of property, plus the $51,000 that we received this year for the sale of the 17 acres that we sold last year. So that would be the source of funds, would be the current funds in Fund 91 for the purchase of this property.
And I thought I saw a total, wasn't it like 300 and, maybe I'm wrong here.
I will have to add that up for you, but it's approximately $464,000.
Yeah.
All righty. So do we need a motion or anything on this, or? All right.
We do, because we have held the property.
Okay,
You approved us withholding the property from the sale. Now we need to actually commit and buy it, and the deed will be transferred to Hubbard County
Okay.
For the HRA EDA development.
all righty.
Maybe, I'm all for it, but at the same time, I got one question about how money's gonna be moved around and everything. When the HRA buys it from the county, then funds come back to the county again, because we're gonna give them some money. So how does that money that comes back to the county, like, some of that goes distributed like to schools and townships?
So
Yeah.
this money will be, the money that's in the HRA account is the tax money that was identified in the capital plan for economic development purposes, right? So that's coming from the levy. But the check will be written from the EDA to Natural Resource Management for the cost. They're actually selling those parcels to the EDA for development. So that then, those funds will be distributed the same way that any other TFL sales going through NRM will be distributed.
Okay.
So it's actually, it's real money. I don't know if it's gonna be a check or if it's gonna be an account entry, but it will actually be money that then will fund parks, fund forestry management, and be distributed to the other taxing entities.
We'll actually get some of that money back then.
Yes. Yep.
Good question, Tom.
Okay.
Thank you.
And then it will appear on the balance sheet for the HRA EDA as land that you have invested or fixed asset until we're ready to resell it for development. So once we have identified a business entity that is interested in purchasing it, then it will be sold again, so.
So we don't need any other formal action from the county board since we already had action to earmark
Yes.
the,
The county board,
$500,000
the county board
to-
accepted the
yeah.
EDA's request to withhold these from the sale. Now the EDA board has to purchase the properties, and then that will process the deed from the state. Will go from state and tax forfeited, it'll go to the Hubbard County EDA as the owner. The total amount is $469,785. As I just mentioned, we had 464 plus 100 plus 51, so there's just over $600,000 available.
but of the Enbridge money that's collected, we have already authorized 500 a year that goes to EDA.
Correct.
So it's already there.
And that's, I'm
Unless we
representing,
change that. Yeah.
that's in the 2025 budget for Fund 91, which is both EDA and HRA.
All right.
So yeah, it'll go back to the county, but some will go to school districts, some will go to forestry or natural resources.
It's being purchased over the counter.
Just our own money
It'll
moving
be
around.
taxable land as soon as it's converted. So next year, we got a budget to pay taxes on this. And hopefully, at that point in time, we have a development agreement so that we, you know, sell this off and start developing additional tax capacity up there.
All right, great. So a motion?
Oh, go ahead, Tom.
I'll move.
Thank you,
And I'll
Tom.
second.
Thank you, Shar. Any further discussion? All those in favor say aye.
Aye.
Opposed? Motion carried. Thank you. The new 6B. That would be the parcels that we okayed at the board meeting.
So that would be to authorize the purchase at the price, of $11,761.70 for parcel 0703-01080, for housing development. And I think it'd probably be cleaner to take, action on that item separately, but we may want to have the conversation about the two different layouts for the development. Maybe you want to have that conversation this first, bit about what Matt had.
Sure. So at our meeting last month, we talked about this parcel is divided almost in half by 107 that goes up through the middle of it. And the desire to potentially start with dipping our toe in the water to do development on the east side, and then look at the west side in the future, and part of that would allow us the opportunity to potentially get some logging in there and some of that stuff to help offset the costs that we're actually acquiring the parcel for. So I talked to Matt Murray about drafting a couple of options for us on what we can do within the existing county guidelines for development of those parcels. And what you have in front of you is the option that would include doing a plat. And we can plat just half of the parcel. So we can just do the 21 some acres on the east side of the road and then wait and do the other side. So by action of a plat or moving forward, we can just address half of the property at once. One of the questions I had for him was there is some wetland in there, and how does the wetland calculate into minimum lot sizes. So that was one of the issues that we talked about. And the sketch that you're looking at shows 8 parcels, but the buildable area requirement of 1.2 acres, only 7 lots may be possible. And the reason for that is, well, there's some additional, I'm just gonna read what he says. So the areas show in each lot a total lot area and a total area excluding the wetland. While it would be up to the final results of a wetland delineation, it seems like 8 lots are possible. However, the ordinance also requires the dedication of a 20-foot easement outside the road right-of-way. Based on the definition of buildable area, it is my understanding that the easement area needs to be deducted in determining the buildable area. This deduction would likely result in the loss of 1 lot unless there is a loophole that he's not familiar with. So he made all the lots 150 foot wide, which is the minimum that's required, and allocated the excess width lots more to the wetlands. So he tried to make use of every possible sort of foot that we can. But with the 8 lots, there would be, we are running approximately 0.18 acres short on area to achieve 8 lots. So the question is, would the county grant a variance to create a substandard parcel, or should we just have him go with 8 lots or 7 lots, which would then keep us without having to have a variance, is sort of the 2 options. The other option that we can do, if we don't go down the route of a plat, is that we could do a, what's it called? Just by doing it by survey. So without doing the, a full plat, we would do a division by survey. That would be cheaper, but the it would be a minor subdivision with a certificate of survey. The downside is that then we'd be limited to 4 parcels in a minor subdivision. So if we don't go down the plat route, then we would end up with what's called a minor subdivision and only end up with 4 parcels, where depending if we want to do 7 or 8, you know, we nearly double the usable space. If we have a way of not having him attend the meetings for the Hubbard County, so the hearings and those kinds of things, we would save at least $1,500 off of the quote that he's provided, which I'm guessing that there wouldn't necessarily be any reason for him to have to attend. I could attend each of those, and that would be a fairly significant cost savings.
I guess one observation about 7 or 8 lots is if you were going to go with 8 and you had to have a variance on one of those lots, you're putting a burden on somebody that might be purchasing that lot. I don't see the point to that. Myself, if this was to move forward, I guess I would rather see 7 lots. It's a little more buildable space. You're not going to encroach onto the wetlands as much because you can make the lots wider. You're not going to go deeper, but you can make them wider. Gives each person more usable space for a well, a septic, if they want a attached garage, detached garage, anything like that. To me, it seems a little more versatile. I'm not saying you can command more dollars for each lot that way, but it might be more desirable in some instances.
And then I can probably add that, having been on the Board of Adjustment, if a private developer came with something like this, I would say reduce it down to 7 lots, so we don't have to do a variance.
Yeah.
So the same thing to a government authority to me.
You have the opportunity to succeed, you just need to choose to do so.
Yeah.
I would agree with both of you, and a question, excuse me, Jeff, but a question I have is, so the land that's wetland, is that, I know it's wetland, but, you know, is it wet, or can children play back there, or whatever? So if I was buying a lot, is it non-usable for me at all, or is it just something I know that has to be taken into consideration?
I think the answer to that would be significantly based on if we're in a drought or not in a drought.
Okay,
So right now, I would venture to guess that there's a lot of space that's pretty usable because we're significantly dry.
yep,
If we turn and become wetter, then there is a potential that wetland could expand and then to be less space that was usable.
but there's not cattails and stuff on that right now?
No, and.
I don't think so.
Just from a point of perspective, this is the area that we're looking at. We're looking at this 40,
Yep,
and what his concept sketch is showing is going to half the depth. So there's 660-foot deep lots.
okay.
You're 240 feet clear from the road before
Yep.
you get to wetland.
Yeah, I know, I get that part. I was
Yep.
just wondering if it's usable at all for.
This green this is wetter. The pink
Okay.
is wetter
Okay.
than the green, and we're not even encroaching onto the pink.
Okay, that's helpful, thank you.
The theory is that we wouldn't develop that really wet part at all.
No, yeah.
And keep that as county ownership or something with it. I don't exactly know what. But the concept is that we're only going to really take advantage of the front half, and the back half will have to, I don't know, we could potentially
Let it go tax forfeited.
let it go tax forfeit. Or give it to the DNR
Well,
or something, I don't know.
The
or-
truth of the matter is, one of I'm gonna slide out just a little bit. This is all DNR forestry,
Okay,
or these parcels are DNR forestry. If we go, and their concern was not having access to this, if these two parcels were made into taxable parcels. So if we go seven parcels, and we leave an easement across the north side of this for them to get to their others, that will be working in cooperation with them in planning for the future, that the next 80 to be developed after this is really committed would be the 80 to the north. They would have access to these parcels. If we did go 8 and went with a variance, Commissioner Kiernan, we would incur the cost of that as the development, and we would spread that across all the parcels. So no one parcel would be hit by the cost of going through that or creating that circumstance. But I do think it's probably better if we take leadership and only ask for variances when we need to ask for variances. But 7 parcels versus 4 parcels, I think, is worth going through the cost of the platting process. And when we start selling some of these, we have the development money to turn around and go on the other side of the road. Because to develop that out fully, because there's not wetland there, would show that road coming in and bisecting this 40 going north and south, so you could get lots on both sides.
yeah.
So, Mr. Chair, I would agree with what Tom, Steve, and Jeff have all said.
Yeah. So I'm
And I
wondering,
would
do
be
we-
supportive of 7.
yeah, so do we need a motion or just a consensus?
Just
Well-
I just want to have one quick comment. I think maybe we should include in all of these estimates a true wetland delineation process, which is an additional cost, but, it wouldn't be able to be conducted till the snow is gone, but a true wetland delineation might be helpful.
And then the lot would really be clean as far as.
They would just go out and mark.
Right,
Yep,
right,
but it
but
would
then-
be clearly defined.
Yep, and
For
so then when
someone.
people buy their lots, it's, yeah.
So the platting of it would not require a full delineation, but it would require the identification of the septic sites and the
Yes.
sites that, septic and well sites on each one of these parcels. Do we want to encumber the additional cost of the wetland, or do we just want to make sure that these are fully developable sites with good well and septic?
I guess maybe we should just make sure that they're fully developable lots, and the prospective owner would be the one obligated to decide where they're putting their structures, and that would either trigger a wetland delineation by environmental services or their septic needs. So we wouldn't have to get involved with that end of it.
I
But they
think
would
if-
be
if-
buildable at that point.
If we just do a plat, I think that we'll have enough information to determine that each of these sites is sufficient. And if you look at those preliminary sketches, they're showing 150-foot width to 195-foot width, and they're a little thicker where they're less deep, right? Because they're trying to show as much acreage out of that. But if you split that up a little bit more, you would do that as well. And like I said, if we provide for right-of-way on the north end of this to the DNR parcels, truth of the matter is, that's a DNR parcel. We could put it on the southern end where it's more affected. We could work with the DNR to identify
Yeah.
right-of-way for them to get through there.
That'd be high ground, looks like all the way, or most.
Well, there's more, I think there's more high ground on the north side.
Okay.
And they may have access
Already here
through
at-
Beltrami into that area
there's
too. You
dots
can't see
there?
it on our map. The only other thing I'm,
It's a house and a driveway.
Yeah,
the
okay.
only thing I'm concerned with plating is with driveway accesses. Multiple driveway accesses over short distances are sometimes not allowed through the highway departments.
Yeah,
So we need to make sure that that area gets looked into as well.
Okay.
Maybe it has to be shared accesses for some reason, and I certainly wouldn't think it would require a frontage road by any means, but
If you look at the density of the lots here and the accesses and the build-out, we're proposing nothing more dense than the stuff on the left-hand side. The stuff on the right-hand side all has is platted and
Circle Drive.
has the circle drive. But the stuff on the west side is approximately the same density that we'd be proposing. But we should check with the township because they might have, they don't have a road, they did not have a road.
Yeah,
No, they just want to make sure that we would stay to their standards, but they wouldn't have anything.
They wouldn't have a driveway restriction.
No, they wouldn't have a driveway restriction at this point.
and I don't think they had zoning.
No.
No.
Okay.
but they might just make sure like in Arago, what we haven't specified then it is to county specs, so.
And this, we aren't proposing building a road, it would just be the driveways, and so
Yeah,
that
yeah,
we'll
but
just have
that's,
to check on
yeah,
that.
check on the
and see.
driveways, that's what I meant,
Yeah,
yeah.
absolutely.
Good point, Steve.
Yeah, very good.
Okay,
So I think it would be cleaner to have two motions. One would be to purchase the property at the reduced rate of
11,718. 70.
11,761.70, which would be coming out of those same funds.
I'll move to do that.
that was Shar, thank you.
That's the entire parcel then.
That'll be both, the full 80, and then the next one, we'll be talking about plating, and we'll be talking about plating the eastern half.
I'll second Char's motion.
Thank you, David. Any further discussion? All those in favor say aye.
Aye.
Opposed? Motion carried. Now,
And then
the
the-
second part,
The second piece would be to go with the proposal for plating and the development of 7 parcels instead of the 8 that are shown.
Mary, do you have enough firm interest that once we put these on the market, developers would want to start? Okay.
I have been in contact with actually 3 developers. One has some interest in doing rental. The other 2 would be for purchase, owner-occupied purchase. So, yeah, I'm fairly confident that there will be a lot of interest in these 7 parcels, so.
So we need a motion for the 7 parcels, right? Okay.
I'll move to approve a development of 7 parcels on this east side.
and I'll second it. Any further discussion? All those in favor say aye. Aye. Opposed? Motion carried.
So then the next thing that we'll need to come up with, as Mary just brought up, someone's interested in developing rental and someone's interested in owner occupied, we'll have to come up with the development terms, and the conditions that we would put on the property to sell them at a certain rate.
Okay.
And our intention would be, remember, to sell these at the discounted rate to incent that, the discount in the purchase of the property, we intend to pass on to the developer so they can pass it on to the owner.
Yeah.
So by rental, do you mean single family that would be owned and then rented out? Or an actual rental unit?
It would be single family that would be owned by the developer, that
Yeah.
would be rented to single family.
So long-term rental as opposed to
Long-term,
short-term
yeah.
rental.
Long-term rental properties.
We would have to have the conversation about whether that is the intent or within the scope of the intent.
Well, and I have some concern because of the use of the parcel and our discounted rate in getting that. Is rental really hitting the niche that we are claiming to serve and the need that we're claiming to serve? Based on the housing study, it is very clear that affordable or workforce type owner occupied is really the need in that area of the state, of the county. So I'm not opposed to it, but I want to think a lot about whether or not it's appropriate to do rental up
Plus,
there.
it might discourage people from doing owner occupied.
Right, yeah, so,
It'd be one of those things if somebody bought the parcel and built a house on it and lived in it for a few years and then decided to rent it, I don't think we would really have any say at that point. But to sell it with the intent that they're gonna build rentals,
Do you-
I think we gotta look into that a little bit.
Do you want somebody building duplexes on there?
Yeah. Yeah.
And sometimes duplex is the way to go. I mean, if you own it, live in one, rent half, that's hard to argue with.
Yeah, yeah.
But then, do you look at quads?
And there's
But it
also,
changed, oh,
I was also gonna say, since we're just doing the east half, maybe we do allow something like that over on the east side, see how it works out. Or maybe we do that but not do it on the west side. I don't
it
know.
changes the flavor of the neighborhood.
Yeah.
I'm not saying one or the other at this point, but it's a different.
Yeah,
And some of the places I've driven by all over, I see a lot of that transition from duplexes or twin homes and then into single-family homes. It's almost like it's a buffer between apartment complexes, then they go to the next stage, and then, but there is a separation, and you would naturally have that here. But
Honestly, I think we would, for the first, if we have enough interest in developing owner-occupied, single-family, that we would limit it to that. You obviously could change and make that more available if there was real demand for that. I think the housing study identifies single-family occupancy as the primary need. But we've had a developer inquire, so at some point, we're gonna have to write the development terms in a way that really define what it is that's acceptable. Otherwise, we're gonna find ourselves in a bind. When somebody wants to buy it and we say no and we don't have cause.
and not only what's acceptable, but where you would want it in your grand plan.
I think owner occupied housing is probably what our intention was when we started this, to give families an opportunity to get started, at least have somewhere that they can call home to begin with, and if they choose to move up to something larger in the future, that's totally up to them, but I think owner occupied was our intention, in my opinion anyway, not rentals.
and I would suggest I'll start working on, as we're working now on the plating process, behind the scenes, I'll also start working on some potential development agreement language. And part of that, I think that the easiest thing to do is have some owner-occupied restrictions so that it has to be occupied by the owner or a owner for a certain period of time in order to recoup the benefits of the discounted sale price. or they're subject to repayment. And so that's one of the things, we either do a deed restriction or a covenant as part of that platting process to really ensure that that's what we end up with.
The purchase price is $25,000, $20,000 is withheld as long as they develop within these conditions, within this timeline, and then that's forgivable. And if it's not done within that amount of time, then they pay back the full price of the parcel.
Maybe then. I guess, are we done then with 6B, and we'll move on to the new 6C? Community EDA funds?
So this conversation came up in a couple of different conversations. I think Commissioner Karen and we were talking about Akeley and the Wayside Rest and the restroom area. I think we've talked about the city of LaPorte and some requests, and just generally, how does the money that the county is levying for economic development, how does it help the other communities, right? And this is a first shot out there to say, do we want to create a fund so that other local governments can apply for economic development matching funds or project funds? Do we want to allocate some of that money over time to be able to meet some of these needs? The first need, and it's a real need and it's a real budgeted need, is the restroom area in the city of Akeley. They are close to having enough funds to do their project. I think in some instances, it makes sense for park areas to apply for funding through the Parks Department, and in some it would make sense to apply through the EDA. But that basically means the establishment of either a revolving loan fund or pooled funds, and then who would you make that available to? Would that be just to other local governments who would make requests? The first one is to identify a way to help the city of Akeley get this project done, because I think we all recognize that finishing that trailhead and that restroom facility is good for everybody that travels through Hubbard County on Highway 71. Gets a lot of use, and it needs to be done. What's their gap, 10 or 15%?
Something like that. I can give you just a quick overview. So we were successful, I helped them do an application to the Blandon Foundation, and they were successful in receiving $100,000 that is available for the restroom facility. They have raised another roughly $30,000 in community support through a whole bunch of different ways. Right now, they're wrestling with the final plan design and getting the final cost estimates. They, unfortunately, just like everything else, has kept going up. I think last Wednesday, they had a council meeting where they were going to really firm up the design, and so we should have the final cost or relatively final cost estimates. But they really are going to still be a little short. They still have a few more asks that they're going to make, but they are going to be short. They just aren't, we don't quite know exactly how much, but they're going to be short. And it really is a significant benefit to the community to have this done. It brings people off the trail for the community. It provides a lot of people now with that really nice parking, the ability for them to come off the road and use it as a wayside rest. It's a benefit when they have their Paul Bunyan Days event. So it's really an important addition for the community. And I would say it really is, in this particular case, there's a clear economic impact to the community, and hence the EDA pool makes sense. And so that's sort of the Akeley thing, but in that conversation, LaPorte has mentioned that they have some needs there as well. I would imagine if we talked to Nevis that they would, and even the Lake George area would have some things. And so does it make sense to develop a pool that the communities can access long-term. So it's kind of two asks, but it really does allude to a bigger kind of thing.
What kind of skin in the game do they have in it so far?
Akeley?
Akeley?
Yeah.
That 30,000 that they've
Yeah.
raised, I don't know that the city has actually committed any additional funds. They did commit funds to getting the parking lot done and working with that
They did.
MinDOT grant.
There's some additional, water and sewer lines that have to be installed or to get to the fair. They have agreed to fund those costs, and they have also agreed that they will be responsible for the care and maintenance of the facility after it's constructed. So the community, the city itself has, come to the table with resources, by way of the extension of the utilities necessary and then the ongoing maintenance.
So the one question I always ask with this stuff is, what's the benefit to every county taxpayer? In this case, you know, you can't, like a housing development, you can directly point to increased tax capacity, which helps regulate everybody's taxes. In this case, you can point, it gets harder, it gets to be more of a gray area, and you can see where this could spiral out of control a little bit if you don't have a rigid idea of what, rigid criteria. You could make the argument that tourism, it's gonna benefit tourism and more people are gonna visit Akeley and use the facilities and spend more money in it, but it's not a direct like it is with tax capacity. So that's the only part of it that worries me. is, you know,
I like the two, though, that they've been doing this project. Steve maybe knows better than I, but they've been working on this for
A few years.
You know, and like Mary was saying, that they have had some dollars that they've put into it, and they've gotten a grant. So we're looking at like a 10%, you know, or like, I mean, are we looking at like $10,000 or, I mean, and this is just a guess.
I'm thinking probably about 25 is what I think is probably gonna be where they're gonna end up, just based on, the inflation. I think originally, a year ago, when we were talking about it, they were really, really close, but the costs have really gone up, and they're trying to be as frugal in the design and engineering as possible with it. So I haven't seen the final numbers, but that's kind of what I'm guessing is gonna be the number.
So the development of this pool would be two things. One, identify the criteria with which we would measure applications. So we get at, okay, how does this benefit? Who does this benefit and how? Some way to quantify that. And then two, it doesn't happen till it's funded. So
Well, so my next question was, you know, when you're talking about developing this local government pool, can we do that inside an RLF? Inside an RLF, can we have a forgivable loan inside an RLF? In a case like this, if you're concerned about the benefit to all taxpayers versus the benefit to the community that's doing it, if we had an RLF, we could borrow the money at whatever interest you want or zero, which gives them time then to recapture that on their own with their local tax dollars versus the rest of the taxpayers of Hubbard County, which might not have a direct benefit.
you could certainly build it into a business type revolving loan fund and let them be a qualified applicant for these funds, and then you could have forgivable or long-term or low interest rate. You could have all the different, you could do it, just build it right into the RLF if you wanted to.
So I guess that's the way I would prefer to work a fund like this, because then you can get them the money they need to get the project done, and then you can determine, you know, do you want to be the party that funds it, the EDA here, or do you want them to be the ones that end up funding that portion? But you're giving them time to figure it out, and you're getting the project done.
And it gives us options. So I kind of like that.
And then the other thing with the revolving loan fund, there's other options to get revenue from the federal government that we could get a substantial revolving loan fund funded quite rapidly and to a significant amount. We would still want to put some local funds in, so, because the rules with the federal thing might not fit every little thing, so that we could still do things like this project. But that's the way I would like to see it go. I think it gives us maximum flexibility, and then we can answer those questions when these projects come along and determine, do we really want all the taxpayers of Hubbard County paying for this, or just the ones it's really gonna benefit?
So would you figure out a limit by you would fund a percentage of the total project up to X amount to it, or would you look at each individual project and then decide?
And for me, I would answer that fundamental question. If you can't say that there's a direct benefit to all taxpayers of Hubbard County, then you probably shouldn't be using tax dollars from every Hubbard County resident to fund that. You should be looking at,
Yeah, but
a
I'm saying,
revolving loan fund or something else to help make up that gap.
so for an example, what if Akeley needs 10% of their total project, but we decide we're only gonna fund up to 5%? That was what I was asking.
I think it would depend on the project.
Okay, so you wouldn't
You
put
know.
you wouldn't list a percentage?
Yeah,
I would
because you might have a project that comes along that you can answer that first question easily. And then
So
you would want to be able to do what you need to do to make it happen if you wanted it to happen.
I would expect if we were talking along a revolving loan fund kind of scenario, that you would set a maximum loan amount based on the pool of resources that you have available. Because you wouldn't necessarily want one applicant to come in and take your entire pool.
Right.
So you would set your maximum amount of what one person or what an entity could get based on the size of your overall pool.
So that would be the
Then-
percentage?
Right, and that would be, we have 100,000, therefore we're only gonna give 20,000 or whatever, whatever that is. And then the second criteria in there is that generally gap lenders, which is what this would be, would say that the borrower has to have usually 5 to 10% of their own money in so that they have skin in the game. And then it's based on the particulars of the specific request. So, how much equity is there and those kinds of things. Now, when you're talking about a business as opposed to a governmental entity, it gets a little muddier. And it also, it provides options, but it's also not as clear what that repayment potentially looks like over time. One of the things I will say is that some of these community projects are really important because we all do better when we all do better. So if the city of Akeley gets this restroom and it results in them being able to have more people visiting, more people frequenting, then likely it will mean that they'll have more economic and we won't see businesses closing, which then end up in potentially tax forfeit or, so it's sometimes very difficult when you're talking about economic development to draw a straight line between the resources. Some of it is what if, but I think that that's part of the responsibility of this kind of entity is to think about how do we ensure that all areas of the county have access to resources that will allow them to do better long-term. And so that's really some of the question that we would have to sort of tackle when we figure out how to design this.
It's also
that-
allocating some of the Enbridge funds captured for that purpose to projects throughout the county as we kind of discussed. It's not an increase, it is county money, but it was captured for the purpose of providing economic development, and it would keep them from having to levy locally for that project. So I think there's plenty of room for conversation about all of these things, and if there isn't, then we don't have to do it. But if we do it as part of the RLF, which we want to put into place, then each one of those things could be evaluated on a case-by-case, application-by-application basis.
I'm not opposed to it, I just want to be careful here, because I don't want to enable our other smaller communities to just expect that the county's going to always fund some of this stuff. I want them to take the bull by the horn and create some of their own mechanisms for doing this, instead of just always coming and expecting this entity to do it. Because there's only so much money. And then it gets hard to determine and make sense of which one you're gonna do and do it. Everybody's got a good argument on why it should be done. That's why I use that one question all the time, because that makes it pretty clear in most cases. But the other advantage of doing it inside an RLF, you can kind of build in some performance standards too. You know, if you perform, this will be, and this is what it turns out to be, then maybe it's forgiven in 5 years. If you don't, you gotta pay it back. So the taxpayers aren't on the hook for something that was gonna be this and turned into that.
I think that right now, this was only a discussion item, and so it seems like there's at least interest in moving forward with something. So Jeff and I can have some conversations about looking at what other pools look like and come with some ideas. Akeley right now isn't quite ready, so, but they will be soon, and so the timing is perfect for us to start having these conversations.
Yes, good conversation too, thank you. So with that then, I guess we'll move on to the 2024 financial report.
And I'll start with the ones that we received from DW Jones. And I reviewed them quite a bit, and I have some decision points that I think that we should talk about. What I included was the balance sheet, and we'll start with Cornerstone, which should be the first one on page 14. And I'm gonna highlight a couple things that I think that are informational but do warrant some discussion. First of all, the cash management or prior cash management that they have,
Which page 14?
I don't know, the one that I printed, or 4 of 33 maybe? Okay. There's two numbers, and so that's why I was a little confused. There's a significant cash prior management. What that really is funding that the HRA has over time put into the operation of Cornerstone, be it the original construction of it and the funding of just the operations from a cash perspective. If you look at the audit report, it refers to that funds as either an interfund balance or providing a cash. That amount is still a little suspect. We're working on that, but it's not a slush fund as indicated sort of on the DW Jones financials. It's really, there's money, or there's a reason for it. Cornerstone in particular, just a really quick, is that for many years it operated in a very significant deficit, and the HRA used their resources to keep the funding afloat. The project didn't get rent.
If I can interject, way back when, it wasn't the most we could charge at Cornerstone was $25 a month for rent?
Well, it was 30% of the income.
Right.
But they couldn't, they couldn't be excluded even if they didn't have income.
Right.
So what ended up happening is that most of the units were provided to the tenants at no cost, because 30% of nothing is nothing. And so for a lot of years, that was the way that was operated. And there would be significant deficits every year, year after year after year. And I'm not saying that that was a bad thing. It was a choice that was made. But I think that it got too far before anything was taken. And so that's where that's from. The second thing I wanted to highlight is the allowance for doubtful accounts. That showed up in the December financials. There's two issues that I have with that is number one, that I'm not exactly sure what it is. I have a suspicion of what it is. And the second one is that they didn't ask for the board to approve write-offs. So right now, this one's just an allowance, which means that they don't expect that they're going to get collections. So it hasn't been technically written off. But I think before they would have, I think from going forward, I'll have them provide us with some sort of something that shows why they're coming up with the number, whether it be, oh, we're always gonna do X percentage for an allowance, which is a board decision. You know, with your loan folks, you set an allowance at 3%. So based on your criteria, you've set a percentage that says, we think that there's a chance that 3% of our overall loan portfolio is gonna go bad, so we're gonna set up an allowance unless we know that a particular loan is bad, and so then we include that in the allowance. You haven't had the opportunity to make that policy decision, so that's what we need to come back with, is create that policy decision on what gets set up as an allowance, because it does impact your bottom line. The other thing that, well, we'll talk about that later. We'll go on to the next page there. And then again, the retained earnings that is listed on for Cornerstone Apartments is that negative 277 some thousand. That's really more of what the overall investment is in that parcel, based on the long term. It is actually getting better now that we're able to start charging rent. This year was really bad because we had that really bad apartment. So we're seeing a very significant loss in this particular year, and most of that has to do with the cost of that apartment. The other thing that's not included in here yet is depreciation. So we have not booked the depreciation of the any of the assets on this. On the next page, the management fees on Cornerstone are based on $75 per occupied unit per month. So if all of the units had been occupied all 12 months, the management fee to D.W. Jones is $8,100, but there was units that were not occupied for some period of time, so that's why we ended up with the $72 as a management fee. That one's really easy, straightforward. It's X amount per unit per month, and so it's pretty easy to see. The other thing, though, that we need to work on here is they're showing property insurance of $5,400. That is like way too high. The Cornerstone Properties is actually still grandfathered in under MCIT, so the insurance for that is a couple $1,000s a year, not $5,000. So I have to check with them and see what they actually paid for insurance, or if it's just their allocated amount based on something. MCIT is insures Cornerstone and then one of your single-family properties. They stopped insuring rentals for counties quite some time ago, but because your properties were already on the books, they're grandfathered in, and as a result, It's significantly cheaper to insure, and it's not $5,000. So I have to check on that for them, which will make it, the financials a little bit better, but not a ton. And then on the last page, this is going to apply for, or the next page, I should say. This is gonna apply to actually all of the properties. The HRA hasn't really, they have a loose capital expenditure versus fixed asset plan. Generally, it's over $5,000, but then they have been calling most of the appliances and all of those things as fixed assets as well, which from a burdensome and financial reporting perspective gets a little onerous when you've got $1,000 refrigerator that you are depreciating over a 5-year period of time. You end up with a lot of what's termed as general assets on your regular financials. I would propose that the handling of the way that it's reported with D.W. Jones is that all of those small kinds of fixed assets, which is, you know, fridges, stoves, microwaves, AC units, to a certain extent flooring, snow blower, any of those things would just be considered a capital expenditure and expensed in the year that they're purchased. And that we would not consider them fixed assets for the purpose of a fixed asset. And so anything moving forward would not be included on your fixed asset, and your general fixed asset line item account, which I'll show you in a little bit, will over time just go away, and we'll just really track buildings, significant building improvements, and any large equipment purchases like a security camera system, those kinds of things we would track and depreciate, and then these small items would just be expensed on an ongoing basis. They are tracked independently through D.W. Jones, so it's not like we won't know where the fridges are that are going wherever. It's just that it's from in the scheme of things, it makes our financials a lot cleaner if we don't have to do all of the work associated with tracking these small assets.
If we, when we redo the county procurement and capital assets policy, it will inform this pretty well. And we can give this to D.W. Jones to refer to it, but anything with a life expectancy less than 20 years or a value of less than $25,000 really doesn't belong on a capital asset program. There's other ways of maintaining that. I mean, trucks don't last that long, refrigerators don't last that long.
How would you handle that if you were building new though, and you were buying 50?
Yeah, the capital
Then
asset.
you would do an initial one-time deal and then transition to
Yep.
what you're doing now.
And our capital assets policy will address that, because we won't be inventorying the desks downstairs, but we'll be identifying a group of equipment that was purchased that cost $150,000. We won't tag and asset track every individual piece, but we'll identify that we spent $150,000 on capital assets. Yeah.
Yeah, and then depreciate them over time, and so, and you'll notice that when we'll talk a little bit about Meadowview and Meadows Edge, one of them pulled all the appliances and as one group, and then one didn't, and the depreciation between the two is different because of that. So, when we look at Meadowview, the one thing that I wanted to highlight there is you'll see that there's land of 251,200. That's for the entire parcel that includes both buildings. So if you look at Meadows Edge, you'll see that there's no land, and it's because it all was incorporated in the first parcel that was actually built out. We can separate the value, but in essence, it's, you know, it's 6 of one, a half a dozen the other. But just, if you're curious, that's where it is that they're both actually on the same tax parcel. And Meadow View was built first, and so they got the allocation of the land, and Meadows Edge didn't. So that's what's, that. Now, when we talk about the management fee, of Meadow View, Meadows Edge, and Regency are all treated the same, where you pay 7% of, and I looked up the contract because I was trying to figure out how to get to the number that's here, and I haven't quite been able to do that yet. The contract says tenant rent, garage rent, resident fees, forfeited damage deposits, and charged amenities. In the case of all of these properties, while Regency has garages, we don't charge extra for them, and we don't have any charged amenities. So those don't apply, but if you take the rental income, forfeited deposits, late fees, and NSF fees times 7%, it doesn't arrive at the number that's listed on the financial statement, and nor does it if you look at the budget. So I have to get together with them and figure out exactly, I've tried numerous sort of groupings of the assets to figure, or the revenues to sort of figure out how they got 7% or what they're including to get 7%. We aren't off by a lot. It's like 6.8%, and sometimes it's 7.25%. So it's in there, but it's not one that I can just, right now, I can't just double check the number because I don't know what they're adding to get to it.
Mary, if you go to the second sheet of Meadowview balance sheet,
Yes.
under liabilities and equity, other liabilities due to Hubbard County HRA 29,000. Was that the money that we paid erroneously to them and they were supposed to refund back? What is that?
So there's, anytime that the HRA has advanced expenses for any of the properties.
Also for that pool that they've put the money into?
Right,
Okay,
yeah.
got it.
So you might recall, we sent them extra money to, do the trees and some of their payroll.
Yep.
They put it in that account because it is recognizing that the HRA had to help cash flow the particular apartments. As we move forward, I'm gonna have them make some changes that are more descriptive so that we can easily sort of understand what's going on. We also, though, and it is, actually shows up on Meadows Edge balance sheet, 19 of 33. They have included a Hubbard County equity. So, again, that was something that's new. I don't know how they exactly got that number, and where that came from. But part of the contract is recognizing that they aren't going to hold all of the resources always, that there has to be some return or acknowledgement of return for some of the assets or the cash or income from these properties to help fund other projects within the county. So my expectation is that we will get to this point of having equity on each of those. Again, I just got these yesterday, so I haven't had a chance to really call them up and say, well, where did you get this number? Why is it here? Those kinds of things. But that's really that part of the contract, is acknowledging that there's some equity that they're holding on to. And then there needs to be a mechanism where we can request that they send it back to us based on these discussions. So that's something new, just to call out to your attention that, you know, this is something that is really part of what the agreement is. We just have to figure out the processes that go with it. Unless you had any other specific questions on that, I'm gonna move on to page 30 of 33. I have been able to get, oh, you went too far, go back a couple. Yep, there. I've been able to get to at least draft financial statements of the activities that are outside of D.W. Jones. And so I want to just talk to you a little bit about what you're seeing here, and then highlight the things that we're still working on that need to be alleviated and figured out. So I've been able to reconcile all of the cash and equivalent counts that you see there up until you see Cornerstone checking. Those, from that point down, are the ones that are held by D.W. Jones. The ones above that are all your accounts. We will have discussions shortly about how many accounts are too many, and does it really make sense to have 8 accounts? Probably not. So we'll have a discussion about whether or not we want to have another bank RFP, or if we want to just downsize and move the money into separate accounts. And so that's one discussion. The other thing here is I have it separated by 3 columns, or our 3 funds. So the first one is your general fund, which is your general operations. That takes care of where your levy comes in. That is the most of your down payment assistance programs. Anything that you would do that would be sort of programmatic. The second is the contract for deed program that you administer through the state of Minnesota. It's called MERL. Those are resources that are restricted specifically to that program. We can only use them related to that program, and at some point they're supposed to go back to the state. I have been having some conversations with folks, mostly representatives, that the state should consider releasing those funds because of the resources that we have available there would allow us to potentially purchase and rehabilitate some additional units and sell them under a contract for deed scenario to continue really assisting very low income households meet home ownership that they would not otherwise be able to. But right now, they're state funds and we can't do anything with them. The last column is enterprise fund, which is all your rental activity. For 2024, what I have done right now so that we can sort of be able to get through all of this is I've taken out all of the D.W. Jones activity for 2024. There's still some beginning balances there that need to reconcile, but the activity has been pulled out so that we can look at activity that's outside of the 4 apartment complexes. In this case, there's only 4 single-family units, but so that's where that is. And again, as part of this, there's some changes that really need to be reconciled with some of the accounts based on last year's activity.
How did you get such large negative balances there in the enterprise fund?
So that's part of the cash flow that we were talking about. So Cornerstone has the lion's share of that negative cash balance because the general fund was cash flowing their operations because they were getting no rent. So that's really where that is. Where that's one of the things that we'll be doing is instead of having a negative cash balance, we're gonna show that as an inter-fund cash contribution or so that, again, how can you possibly spend cash that you don't have? So those are some of the cleaning up things that we're going to do. We also did discover that you'll see that MERL, there's an account that's dedicated specifically to MERL, but there's activity showing up in the 2 other funds. So somebody, a deposit was made in error in the wrong account or some of those kinds of things. So we're gonna have to do some actual transferring of funds back and forth once we figure out exactly what the numbers are that should be resolved. And then on the next page, you'll see that there's really significant accounts payable. That's not necessarily what you owe because it includes the interfund payables. So the amount of your actual payables, or the accounts payable line item here includes a lot more than just accounts payable. It also includes the interfund. So that's what that has to do with. On the next page, again, this is the activity of what has happened so far this year, or 2024, that is excluding the D.W. Jones managed department. So right now, what I'm trying to do is just figure out where the smallest operations of the HRA are. The levy only represents half of what we've received. There's usually a payment that shows up in December. That one didn't. So we'll have to do a receivable for that amount, and so you'll see an increase in the amount of levy. The rental income, there was some miscoding, and so the levy or the rental income is gonna go up for those properties. But 2 of the properties also did sell, so there's the home sale proceeds. We'll have to do a closing out from when they stopped being rentals and then write off or either show a gain or a loss based on what we paid, the depreciation, the rental income, and then the difference of those properties. So we'll have to do a reconciliation. You'll see that coming as we're getting ready for audit. And then the other thing that I wanted to mention, construction expenses. We had a category of expenses. They aren't really construction. What they have to do with is a sale. So they're really realtor fees, closing costs that were put together. This was a report that was created when the HRA actually did do construction, and they were facilitated to be under that grouping. So that's really what it is. And then the last thing was gonna tell you is that the professional fees is really related to software. You get your accounting software, you have loan processing software, and you have property management software, and those are all under that professional services. It's really the subscriptions for the software that you have. The next report is one that just gives you a real snapshot very quickly of your properties. So then you can see, again, here's the properties. If you like a report like this, what we can do is also add it so that you can see the general fund activities or each sort of large grouping of costs in a column, and hopefully keep it to 1 or 2 pages so that you can see really quickly what the financials is. The software that you have has a large capacity to create reports that are usable. So part of what I'm showing you here is some of the reports that were done in the past. Not necessarily that these are the ones that you really want to see, but it gives you a sense of where you're at, because you haven't been able to have this information. And then part of it is, yeah, I like something like this, I don't really like this. We can go as high level or as minute as you want to go, and we can do a combination of that. So your feedback will really be appreciated as we start working through this to see how much detail do you want to see on an ongoing basis, and how much do we want to, and how often do we want to discuss the financials on a more in-depth basis. Is it okay just to have them on the consent agenda and we can start working through those? Again, depreciation is not included in these reports. I haven't calculated all the depreciation yet. So that's kind of a whirlwind tour of the financials and a very draft of 2024. I think, right now, without the second half of the levy, it looks sort of scary. But I would expect that overall we'll be in a positive place. The 3 apartments other than Cornerstone all are booking a cash positive. Depreciation, again, isn't included in there, but that's a non-cash. So you're ending up with more cash at the end of the year when it comes to the apartments than you got more than you spent, which is a really good thing from the perspective of the folks that are being served with those apartments. So that's a positive, and we'll keep working through that. Again, feel free to reach out if there's something that you want to see differently, you have questions about it, and we'll hopefully be able to have, next month, have even a little bit clearer financials for you, so.
So the long-term goal will be to be able to show the depreciation in there?
Yeah, the accounting, so this is, the accounting software will automatically calculate depreciation. The challenge is that it only allocates it to one account and one project. We have historically been depreciating so that every property gets their allocation of depreciation. So we have to do a manual entry. And if we can not depreciate these small assets and it becomes just the larger building, larger equipment depreciation, then a manual entry is insignificant in the scheme of things. If we're continuing to depreciate everything and there's a depreciation of $3.12, then it becomes really sort of overwhelming to continue to do that in the way. The software manages all of that. It's how it transfers over into the balance sheet and in the back end. And so from the back end, it looks
Yeah.
pretty, yeah.
Could you,
But once
could
we.
you just figure it out annually and appropriate the amount annually to each one and then just make an adjustment at the
So
end of
what
the
we'll
year?
be able to do is do some of those kinds of things, especially if we're looking at a much smaller
Yeah.
number of transactions. Right now, there's something like 200 depreciation transactions per month.
Oh my
and-
goodness.
Yeah, so we need to downsize that a little bit. And it's not, because you don't really pay taxes on, depreciation is really a book entry to
Yeah.
make it more business-like. So we can do the depreciation, it's just how do we make it so that it doesn't cost us more to do it, the entry, than the benefit of showing it that way. So we'll continue to tweak and get to a place where you're really comfortable with what you're seeing on a monthly basis, so.
More important, just like heritage operations, is the monthly cash flow.
Right.
And seeing how each of the departments or each of the buildings within that unit are functioning. And honestly, relative to depreciation, if you just only show depreciation on a summary of GL accounts activity for the whole operation, I think that would be appropriate. There's no reason to split those things out. They can all run in the background until time for audit.
Because the real value of it is to know each year, are we doing well enough to be able to replace things in a timely manner? You need to know that because that helps you determine whether you raise rates or not.
Right.
Your depreciation account should be offsetting your capital improvement account. Right? You should have the ability to show improvements
Yeah.
offsetting the depreciation of the prior improvements, or you're gonna end up in a bind when
Yeah.
when they get really, really bad.
If you just did that analysis one time a year at the end of the year, and you pulled everything together and threw that in there and say, are we making enough income to take care of the depreciation?
Yeah, so,
I have one question in light of how much work this has been to go back and reconstruct the financials. Does there need to be an adjustment, a one-time adjustment made to the contract amount?
I will pose that question to the board. I am not comfortable making that call.
I know you're not.
I have spent a lot of time in working through the financials and getting them at a point that they're at now, and there's still work to do. But I am not comfortable asking that. I can put it, that board meets next week, and I can put it on the agenda, but I'm not comfortable doing that, so.
Yeah, okay. Because I think that bears discussion, just in light of just that year of.
Okay, if there's nothing, excuse me, if there's nothing more on that, we'll move on to new business. Local Housing Trust Fund grant application.
As you recall, the state of Minnesota, through the Minnesota Housing, allowed for a grant to ask for match based on the creation and contribution to a local housing trust fund. They had the intent to apply open in end of January and close in February, and now they have recently opened the application to submit. As part of the intent to apply, we have documentation that the county contributed $300,000 to the fund, and so we would be eligible to get a match of $225,000. I am fairly confident that that match is oversubscribed. So I'm not sure that the Minnesota Housing will be able to honor all of the requests for that. However, it's not going to prevent us from asking for the entire $225,000 should you approve that. What they ask for in particular related to that is what our expected use of the match is. And they have 3 authorized expenditures that are under statute. One is to make grants, loans, or loan guarantees for development, rehabilitation, or financing of housing. Matching other funds from federal, state, or private resources, and then providing down payment assistance, rental assistance, or home buyer counseling. You can check all that apply. In the intent, I checked all that would apply, expecting that we would want to keep our options as broad as possible moving forward with the future use of not only this match, but the overall use of the Housing Trust Fund. So that is what I have done from that perspective. So what I would be asking for is authority to submit the application. I haven't written it yet. It's due in the middle of March, March 19th. But I want to make sure that you are okay with submitting that application. Once I have it written, I will disperse it so that you can see what it is. And most of it is 1,000 words or less. Answer this question in 1,000 words or less. So I'm pretty confident that with what we've talked about, I can come up with the responses to the questions. But again, I just need your approval to go ahead and work on that application and then submit it.
Do you need a motion or just a consensus?
Motion.
Motion.
So when we created the Housing Trust Fund and we allocated that first $300,000, the intent at that point in time was to create the owner-occupied redevelopment program, which is criteria number 1 under the application. I think based on the application, it makes sense to submit it, checking all 3 boxes as things we may use.
Yeah.
But your allocation of those funds just have to be within one of those 3, and I think our initial intent was at least to set up a local owner-occupied redevelopment program.
I
So
guess-
we're, a year and a half later, we're almost there.
So if I could get a motion.
I'll move to approve the submission of the Local Housing Trust Fund Match Grant app.
Thank you, David.
I'll second.
Thank you, Steve. Any further discussion? All those in favor say aye.
Aye.
Aye. Opposed? Motion carried. Now are we on to the director's report?
Yes. So there was a couple things that I thought would bear some additional information on what I've been working on, that, you know, just not necessarily need to have a lot of discussion, but just want to make sure that you're in the loop on what's going on. The first one is that there was a notice of court documents serving on a redemption suit for action on a property that went into foreclosure. We've been watching that for some time. The value of the property was far less than what they owed on it. Our only recourse at that time would have been to buy out the first mortgage. The attorney said that the foreclosure, unless they go into bankruptcy, the foreclosure process does not eliminate the debt, it just eliminates our lien. So we can then pursue small claims court for it was a down payment assistance of $7,500. So we can pursue that in small claims court once these proceedings are all done. Should you choose to do that, we'll bring that up when this is all done. But it's something that we've been watching, so it wasn't a real surprise. The second thing is, you provided authorization for me to be a power of attorney when it came to the payroll taxes. So with that, I've been able to sort of uncover what's been going on, not without the state having taken some garnishment action. Once I was able to gather all of the information, I did write a letter, which I included, to the Department of Revenue and let them know that for whatever reason, it wasn't reported that you didn't have employees anymore. And so Revenue has been looking for reports and tax payments based on when you did have employees at that rate, and has been assessing fees and penalties. And so the letter is to let them know, here's the proof that this is when we stopped having employees, this is all of those things. I have not heard back from them, but wanted to, again, just keep you in the loop that I've been working on that as well to try and get that issue resolved. I would expect that we will get resources back, because we can document that. It just may take a while before that happens, so.
Well, thank you for your efforts there. I guess with that, if that's all we've got for today, ask for a motion to adjourn.
I'll make the motion.
Thank you, Steve.
Second.
Go ahead, Tom.
Steve and Tom, any further discussion? All those in favor say aye.
Aye.
Aye. All righty.